Hi everybody, welcome back to the Velocity Banking series. Thank you so much for stopping by today. We're going to be doing video number 5 in this series and looking at how our family is using our lines of credit to implement the Velocity Banking strategy. These videos are intended to be watched as a series, so if you are just jumping in now and you're feeling a little lost, I would refer you back to the previous 4 videos to follow along. But if you did miss last week's video, this is just a recap. We had looked at this cash flow index equation. If you have multiple amortized interest loans and you're wanting to know which one to pay off first, using this strategy in order to get the most bang for your buck as far as interest savings. The equation is the loan balance divided by the minimum payment of the loan. And the goal is to pay off the loan with the lowest cash flow index first. That's considered your most inefficient loan, especially if the score is less than 50. If the score is greater than 100, then it's considered to be an efficient loan. And I had, of course, shown you what our cash flow index was for the 2 loans that we had started with in August when we first implemented this strategy. This is a breakdown of our loans on the left-hand side, and then our lines of credit are on the right-hand side. And that's what we're going to be focusing on today, but just showing you we started with a student loan and a mortgage were our 2 amortized interest loans when we started this journey, and we found with the cash flow index that our student loan had the lower score, and so that's what we started with first. And in August, as I had mentioned, that's when we first started this journey. We had transferred over $20,000 from our home equity line of credit to pay down the principal on our student loan. So the starting balance of our student loan was $61,480.12, and the starting balance on our home equity line of credit was 0. When we made that transfer, the principal on the home equity line of credit had increased to $20,000, and the principal on the student loan had decreased by $20,000. And I made sure through the lender for the student loan that any additional payments beyond our minimum monthly payment were only applied towards principal. Now, looking at the interest rates between the loan and the line of credit, it doesn't mathematically make sense as to why you would do this, but we're going to look into some things that we're doing with our other accounts to decrease the principal balance on the home equity line of credit so we're not being charged interest on that $20,000. Now, our home equity line of credit has principal calculated based on what is called the average daily balance. And how the bank calculates the principal is they total each day's balance within that billing cycle, which is usually 30 days, and divides it by the total number of days in the billing cycle. And what this really does is it gives you the potential to lower the amount of principal that interest is being applied to. Just to give you guys an example of what this looks like is, let's say you had a home equity line of credit with an interest rate of 12%, just for the simplicity of doing these calculations. And let's say you started with, at the beginning of your billing cycle, with a balance of $500. And then 16 days into that billing cycle, you were able to make a $300 payment towards principal, thereby bringing the principal balance down to $200. What the bank would do at the end of that billing cycle to figure out how much money they're charging you interest on is they'll take the $500 balance that you'd carried for 15 days and then the $200 balance you carried for the remaining 15 days, add those two together and then divide it by the 30 days that were in your billing cycle. So your principal that the bank is calculating interest on is $350. And 12% of that is $3.50 that they're going to be charging you for that month, as opposed to most other loans that do not use the average daily balance. You would most likely be charged interest on the $500, so the principal balance that you carried earlier during the billing cycle, and that would have been $5 that you would have been charged interest for the month, as opposed to the $3.50. Into consideration this average daily balance on our home equity line of credit, what we had decided to do was house accounts within the home equity line of credit to hold that principal down for as long as possible during that billing cycle, so that when our bank calculated the average daily balance, it was much less than the $20,000 that we'd taken out. And understanding that it is a two-way loan, we can make transfers between us and the lender as many times as possible. And the bank accounts that we started with in August, we had 2 checking accounts. One was a standard checking account. The other one was where we kept our sinking funds. And then we had 2 savings accounts. And we left our standard checking account open because we had paychecks that were direct deposited, and then there were also some bills that we could not put on a credit card that required a checking account number in order to be paid off. And then our sinking funds, what we had done was just close that second checking account altogether, and our sinking funds are completely housed within the HELOC, and we just track them through I do a sinking fund closeout. They're still tracked the same and serve the same purpose. And then I also have a separate accounts tracker sheet that I'll show you guys at the end of this video for all of these accounts. My 2 savings accounts, those were also closed. That money is completely housed within the HELOC. Everything still gets its allocations or deposits every month. Next is our credit cards. Now, some velocity banking strategies, you can actually use a credit card to pay down the principal on the amortized interest loan. We decided to not go that route because we already had access to the HELOC that we felt more comfortable using, but we do use our credit cards to pay for as many of our fixed and variable expenses as possible, and then we just pay off the credit card at the end of the billing cycle every month. So we do not pay any interest on our credit cards. I've been a cashless budgeter for the last at least 15 years and have not ever struggled with carrying a credit card balance. That's just a part of my financial psychology, something that I have not ever struggled with before. So we felt comfortable continuing to do this because this was actually what we'd been doing before we even started this strategy. It just worked well for us to allow money to stay within the checking account, or the checking account money that was being housed in the HELOC, to hold that balance down for as long as possible, with the goal of keeping the principal, again, the principal balance on the HELOC as low as possible for as many days within the billing cycle as possible. And again, we just pay off the entire balance every month, and we do not pay any money on interest on the credit cards. These are the credit cards that we have. We have a Kohl's card, Costco, and a travel card. And these cards were specifically chosen based on our family's needs so that we could optimize the rewards points that each card offers. We are a family of 5. I have younger kids, so we buy lots of clothes, lots of food, and vacations can be very expensive, especially if we're flying. So these are just our lines of credit, how we are using them to suit our needs and give us as much interest savings as possible. I'm now going to switch you guys over to the overhead view so that you can see how we track those different bank accounts that are housed within the HELOC. Okay, everybody, so this is just that accounts tracker that I was talking about that I used to track those accounts that were closed, or at least for checking left at the bare minimum.
so that they can serve the purpose of holding the principal balance down as low as possible on the HELOC. Now this was the one from August because that's when we started this journey, and it's already updated and closed out with what was added, taken away, and what the ending balances were. But I will just, I'm going to go more into this next week when I show you how we're tracking everything. But I do just want to kind of show you the power of doing this. Okay, so you can see in August, what I had done with checking was transferred over $2,600 from my standard checking account into the home equity line of credit. To the bank, it looked like it was a principal payment, but to me, I knew that it still was serving as a checking account. It would still have that same purpose, but it was kind of serving a dual purpose at that point. And since the HELOC's a two-way loan, I can make as many transfers as I want every month to kind of hold that day-to-day principal balance down as low as possible on the HELOC for that average daily balance that the bank calculates at the end of the billing cycle. Okay, so that's the checking. And then sinking funds, this has the exact same purpose that it had before I had closed that second checking account. I'm just tracking it here so that I know how much money is in there. So if I wanted to take this money out or do anything different with it, I need to know how much is assigned to that specific category, which is sinking funds. Then I have my two savings accounts, and again, those both were closed as well, and they get monthly contributions. Again, I'll go more into how I track that on a Velocity Banking transaction log that I have, since that's really, it's not physically moving anywhere. It's just more me writing that the numbers are being taken away from checking and added to that savings account, if that makes sense. But I do still need to track that because I still want all of these accounts to have the same purpose. I'm just keeping that money in a different location. And then next is this cash flow payment. Since this is our debt focus, the home equity line of credit is, I need to keep track of how much money would stay in there and is bringing down the true principal, that $20,000. So if I took all of the checking, sinking funds, the two savings accounts out, how much is left in there to actually pay down that principal in reality? Okay, so I really hope that makes sense. It's a very abstract concept, and it's kind of where you're thinking of your money not as an actual currency. Like, this isn't $2,600 that I have in stacks of bills. How can I make this $2,600 not just to be a stack of $2,600 bills? How can I make it either save me money on a percent of interest or increase by a certain percent? And you're thinking in percents, you end up with numbers that aren't round, that fit into this currency mold to, you know, a penny amount. It could be to 1,000th decimal place or something like that. So it's not thinking of your money as true currency and kind of making it work harder for you is how my thought process had to shift and how I had to change how I was thinking about this. Okay, so, but let's look and see. This is the total amount of money that was sitting in the home equity line of credit. So I taken out $20,000, right? And transferred that on August 6th to pay down the principal on student loan number 2. But what the bank sees, they don't see $20,000. They see I take away this $8,274.87. What they were seeing at the beginning of that loan was $11,725.13. And that's what they were charging me interest on. So that's why this can be so powerful to increase or optimize your interest savings if this is something that you can do with your velocity banking strategy. But that's our process. Again, I have right here this velocity banking transaction log that shows how I'm tracking money that's being added or subtracted. And each category is assigned a color in this checkbox section. For those of you who watch my budget videos, you know how much I love highlighting my checkboxes over here and categorizing with some color. But I'm going to go into that next week, how I use these transaction logs to come to these numbers here and track all of that. But yeah, I hope this sheds some light on how we're using the lines of credit and finances that we have access to optimize our interest savings using this strategy. And hopefully it could at least answer some questions, give you some inspiration, or at least a knowledge nugget to add to your knowledge bank. And I will see you guys next week in this series to discuss our tracking system. If you did like this video, please give it a thumbs up. And if you're not subscribed and you're enjoying the contents of this channel, please consider subscribing, and I'll see you guys later.